Welcome to the first episode of the psychology section. And today we are going to talk about a very important topic, which is emotions. Emotions are extremely important to understand when you do trading, when you are involved in crypto, and when you are playing with money. Because this is what we do. We are speculating on high risk assets in order for us to find a high return, right? This is what we do every day. We analyze chart in order to find entries and to essentially bet on some coins, right? And emotions can be extremely strong, especially in the meme coin market. So we're going to take a look at this right now. Now, let's define what emotions are. Right? Emotions are a conscious mental reaction such as anger or fear, subjectively experienced as strong feeling, usually directed toward a specific object and typically accompanied by a psychological and behavioral changes in the body. Right? So in trading, in crypto, we're going to have a lot of emotions. We are going to experience euphoria when we make money. We are going to be very happy when we make money, and actually a lot of dopamine are going to be released when you make money. Let's say, for example, you 10x your money on some meme coins, right? Then you potentially just change your life, right? Let's say you had $5,000 and then now you 10x, now you have $50,000. Even in a first world country, $50,000 is a lot. So now you have opportunities. You can buy something to create your own business. You can go on vacation. You can change your where you live. You have a lot of opportunity that opens, and this is going to cause massive dopamine spike in your brain and euphoria. So you have two extremes. You're going to have extremely positive emotions, and on the other side, extremely negative emotions, right? And I would say the best way to approach emotion in crypto is to stay neutral as much as you can. It is going to be hard to stay neutral, but you have to try to stay neutral and very calm, right? And the only way to do this is to practice risk management, is to build a strong thesis on what you're investing. And we're going to take a look at this right now. So emotions in crypto, right? So you're going to experience stress. A lot of times you're gonna experience drawdown, heavy drawdown sometimes, maybe negative 50%, negative 80%, negative 100% sometimes. So yeah, like this is crazy. And if you are trading futures, then you're gonna experience a lot of stress, right? We also have FOMO. I'm going to dedicate an entire video on FOMO because it is really important to understand what FOMO is, especially in the crypto market. But essentially, FOMO is fear of missing out, which pretty much happens every day to any meme coin trader because you are scared to miss the next opportunities, right? But if you really think about it, opportunities are here all the time, right? You have the fear of loss. This is usually when you're investing way more money than you can afford to lose. Like, for example, sometimes I get comments on my YouTube channel with people that have lost all their money and stuff like that. And it happened to me at the beginning of my journey as well. Playing with rent money, playing with very important money. It could be very dangerous for you. You could destroy your life with crypto, or you can make your life better. Choice is yours. And this is why it is very important to master your emotions, right? Next, you're going to experience high anxiety. Again, if you're in drawdown, you can experience high anxiety, maybe getting hacked, maybe you lost your seed phrase. So crypto is no joke, man. It's going to bring you a lot of stress. So you need to be prepared. You need to practice risk management in order for you to not go crazy, right? You're going to have fear in general, greed, obviously, especially in the meme coin markets. We are very greedy. The only problem with greed is that you don't take profit. Like, for example, after you already did a 10x, take some profit, man. Like, just be logical. Like, are you going to do a 10x tomorrow? You don't know. Probably not. So your coin has 10x already, take some profit, like lock in some profit. Don't be greedy. Don't be crazy. Don't be like, oh, it's going to 50x. It's going to go higher. It's going to go higher. This is the wrong mindset. You should always take profit, at least initials at 2x, 3x. Like you should think that way. You should build systems and stick to them. All right, next we have overconfidence. This is when you think that you know everything and you made a bit of money in crypto and you are being an arrogant piece of shit. And this is not good, guys. This is really not the way to go. You should not be overconfident. The market is going to humble you very fast. So do not have overconfidence, but at the same time, don't have low self-esteem as well. You have to find the middle, right? So have confidence in yourself, but don't be crazy. Don't be arrogant, because we always learn, right? And then we have panic selling. So panic sell happens in meme coins a lot. So panic selling is not good by itself because you're acting out of fear, which is not good because you are acting out of strong emotions. What you should do instead, you should have a system, like for example, you draw a Fibonacci line, and if you see that it's on the 61 Fibonacci, then you get out, right? You should build systems and respect them and just go with those systems over and over again. So then you're going to have the least emotions possible in the market, right? Next, in trading, we are going to have obviously human instincts, but sometimes human instinct is not good in trading at all, right? Let me give you an example here. Let's say you are playing your favorite video game, right? So you are having a lot of dopamine, you're very happy, and let's say you're eating at the same time, right? So extreme dopamine here, very happy. But then there's a lion that comes in the room. What are you going to do? Obviously, you're going to run and you're going to leave everything on the table and you're going to run, right? This is human instinct. So we have two very strong human instinct. The first one is survival, which is the one right here. The second one is reproduction, right? So it's like sex and all that stuff, right? Reproducing yourself. And basically in trading, human instincts are pretty bad, because trading is the complete opposite of natural human instinct, right? You don't want to have panic. You don't want to have fear. What you want to have is control of yourself, which is very hard to do. And this is why a lot of people are losing money in trading, in crypto, in finance in general, Forex as well. People are losing all their money because they have no self-control. They have no emotion control, right? So you need to learn how to control your emotions. All right, next, how to be profitable. Well, number one, you're going to need to follow a clear process and repeat it all the time. Repeat it all the time. Always analyze chart the same way for months, for years. Do not change. Do not switch your indicators every day, every week, every month. Stick with something. Stick with something so you can have an edge against everybody else, right? Have a strategy in place, right? Have a strategy. We're going to take a look at this in the strategy section of this course, obviously. Follow logic, not emotions, right? You need to operate from a logical standpoint, not emotions. Emotions are going to destroy you if you are not ready to control them, right? Be able to make calm decision under stress, right? So operating under pressure is a really good skill, really, really important skill, because when you're dealing with money, you're obviously going to be emotional, right? Doing the opposite of what most do. So for example, if everybody is selling a coin, should you really sell that coin? It depends. Most of the time, probably not. Most of the time, you should probably hold. If everybody is buying a coin right now and is extremely bullish on it, should you buy that coin? Probably not. So always try to have an edge against most people. That's the only way in which you're going to be successful in the crypto market. Next, obviously, buy low, sell high. A lot of people seem to not understand this one. And that is a big problem. Do not chase green candles. Chase red candles. If you chase red candles, for example here, we can clearly see that the market has retraced on this candle right here. And this was the perfect entry around this area. But most people would have gotten right here or at the top right here, right? So buy low, sell high religiously. So as you can see right here, the loser is impatient, right? He's looking at his watch. He's like, when is the coin going to pump? When's the next pump? When am I going to take profit? Whereas the winner, he's right here. He's chilling. But both invested in the same project at the same time, right? But the loser has no patience. He wants his 10x right now, and he's about to exit very soon because the market is not giving him what he wants. Whereas the winner, he invested money that he was ready to lose. So he is now chilling in front of his computer. He's not even thinking about that coin anymore, right? Sometimes he checks the chart to see if everything is fine, but he already has a strategy in place. He knows where to exit if it goes down. He knows where to exit if it goes up. So he knows when to take the loss and he knows when to take profit. And this is what makes the difference between the loser and the winner. All right, another thing here is I want to reinforce that if you focus, if you control your emotions, if you practice risk management, if you invest in coins which you have built your own thesis on, then you're going to separate yourself from the average people and the average crypto investor. Then you're going to be right here. All right, so this is how we do it. We separate ourselves from the group. All right, guys, so next you have the conscious mind and you have the subconscious mind. So basically, emotions are a part of your subconscious which you cannot control directly. You can impact it indirectly, but you cannot control it directly. The only thing that you can control directly, which is going to impact your emotions, is logical thinking right here. So by being logical, you're going to help yourself being less emotional, right? Same thing with habits. How do you build habits? By repeating, and not being emotional. Repeating. It's also very hard to stop habits. Why? Because habits are a part of the subconscious mind. So essentially, what you have to do is focus on what you can control, which in this case is logical thinking, right? And your logical thinking is going to positively impact your emotions and your habits, right? And also, keep doing the same thing. Repeat the same thing over and over and over again, right? Do the same thing every day. Analyze charts the same way every day. Do the same thing every day. And you're going to become so good, and emotions are going to follow, and they're not going to be your enemy, but they're actually going to be your friend. You're going to build a strong relationship with your subconscious if you do logical thinking. If you practice logical thinking, your subconscious mind can help you. So very explanatory here. You can see that by operating in your logical thinking, you are making money. But if you operate out of emotions, you are going to be broke. You are going to stay broke. So logical mind makes money. Emotions stays broke. Remember this. Next, we have the 4 elements of a successful crypto mindset. So this is very important here. So number 1, understand that you can be wrong, right? So you build your thesis and unfortunately it didn't happen like you thought it would happen. It's fine. Learn from it, move on, all right? But you need to accept the fact that you're not always going to be right. Second, we have proper risk management. You need to practice proper risk management. I'm not going to tell you only risk 1% of your portfolio, 2%. You have to make your own decision, and you have to only risk what you can afford to lose in the market, and especially in meme coins, which are very dangerous and very highly speculative. right? And third, you want to find your asymmetric bet upside. So basically, you want to find a coin that you truly believe that has a strong potential to go up in the next few months or in some short period of time, but like not like 5 years, 10 years, but like next 6 months, next year, next 2 years, you have to find that coin, right? So find your asymmetric bet. Once you found it, once you think that you have found it, build a thesis around it, right? So find a reason why would this thing pump? Why would anyone buy this thing 6 months from now? Who is gonna buy this thing, right? Is it a new blockchain? If it's a new blockchain, how is this blockchain gonna bring people into their blockchain, right? Like for example, Ton. If we take the example of the Ton chain is easily gonna bring people because they are obviously Telegram, so they have more than 900 million users per day that are using Telegram. So they already have the people that are going to use the blockchain. Same thing with Base. How does Base is going to onboard people? Well, they have Coinbase. So everyone that has a Coinbase account indirectly already can be connected to Base, right? So this is how you build thesis, is by understanding what's going on, what's going to happen, looking at news, looking at which blockchain you are in, and build a strong thesis, right? That's how you do it. And we're going to take a look at how to build a strong thesis for meme coins in this course, right? Next, stop switching strategies. Very important. Stop switching strategies. Repeat the same thing over and over, and this is how you're going to get good, right? I've seen way too many people in crypto, in forex, in any financial markets. People are switching, like they're switching strategy all the time. They're switching from a scalper to a swing trader, like just like this. Like it doesn't make sense. In order to be good at something, you need to practice the same thing over and over, right? So sticking to one thing will give you an edge against everyone else. Be the best at one thing. Choose your style and stick to it. So we're going to talk about trading styles after. Repeat the same actions, right? So repeat the same actions over and over and over again, right? I can't stress this enough. This is very important, okay? Bruce Lee said, I fear not the man who has practiced 10,000 kicks once, but I fear the man who has practiced one kick 10,000 times, right? So the more you do one thing, the better you're going to become at it. The more you do everything, you're going to be a loser. You're not going to be good at anything by doing everything, right? So remember this, okay? Now define what you are. Are you a trader? Are you an investor? Are you a scalper? Are you a degen? Are you a swing trader? What do you want to be? You want to be a degen loser and gamble all your money on meme coins every day? Go ahead. You want to be a scalper? Learn how to be a scalper. Take your time. Take 6 months to a year. Practice. Collect data, right? Collect data. Do Excel sheets, Google Sheets. Like, you know what I'm saying? Like, take data. Like, build data. Build a database of what you have done, of your exposure to meme coins, for example. Like, build a watch list of which meme coin you have invested in, how they have performed. Take screenshots of the charts. Like, just be that guy. If you want to be successful in crypto, act like the people that are successful in crypto, and you're literally going to make money just like that. So start putting the work. Welcome to the second module of the mindset section of the course. And today we are going to talk about a very interesting concept, which is called the house always wins. Now, when you think about the house always wins, you obviously think about casinos. It makes you think about Las Vegas, crazy gambling, crazy gamblers, etc. Well, this applies to crypto as well, and I'm going to show you why. So, number one, we have to define who is the house. What am I talking about when I'm saying the house always wins, right? So, the house is the founders of a project, the founders of a trading platform. It could be the developer of a new crypto, a meme coin. It could be the marketing team of a project. It's just not us traders and investors. We are not the house, right? And you have to understand that in crypto, people that make the most money are a part of the house. So basically, here I put Binance because Binance is one of the biggest exchange in the world, and they make a lot of money with crypto. And what do? They don't trade coins, but they make it so you can trade coins. Do you understand? They bring value, they bring a service, they bring a product, and they sell it to us, to the Digens, and they make money when we lose. That's how the game works. Now, BlackRock is now the house as well. It is actually a venture capitalist in many projects, right? Same thing with Dragonfly here. Dragonfly is a venture capital crypto fund, right? So they invest in early crypto projects and they make money. And you have insiders. Who are insiders? Well, insiders could be somebody that has a huge KOL, a huge audience, and he has access to private chats with important people in the crypto space, and therefore he gets token allocations or he gets early entries, whitelistings, private sales, etc. And then below that, you have the smart retail. So smart retail are your favorite traders, traders that make money, that are actually profitable. And this is actually rare. There's only about 5% of people that are a part of smart retail, right? 90% of people in crypto are dumb retail or exit liquidity, right? So that's the people that go on pump.fun and lose their money. That's the people that come late in the cycle and they are being used as exit liquidity. So yeah, so you have to understand that the real way to make money in crypto is not necessarily to buy crypto, is not necessarily to trade meme coins, but it's actually bringing value, creating a product, creating a service around crypto will make you way more money than betting on coins, right? And so now I want to take you back to 1849 when they started to discover gold in California. The California Gold Rush started in 1849, and essentially you can see it here. So the California Gold Rush, sparked by the discovery of gold nuggets in the Sacramento Valley in 1848, was a pivotal event in American history. Thousands of prospectors, including men and a few women, flocked to California, transforming the territory's population from less than 1,000 to over 100,000 by the end of 1849. Now, why is this interesting for us? Well, when you look at these people that were digging gold, right? Do you think that these are the people that made money during the gold rush? Think about that. All right, I want you to think about this. Answer the question by yourself. Answer the question, and we're going to see the answer very soon. Okay? So are these people, did those people made money? Right? Was it the people that were selling shovels that made the most money? Or was it the people that were digging for gold? Right? Well, the answer is that the people that sold shovels are the one that made the most amount of money, while these poor, hardworking diggers didn't make that much, right? Sad. And history is always sad, but this is how the world works. All right, next. So where does this come from? It comes from this whole idea that the people that sold shovel made more money than the people that were digging gold. Therefore, anytime you are in an industry, you don't want to do the thing that everyone is doing, but you want to be the provider of the thing, if that makes sense, right? So here we can see these shovel sellers reaped significant profits, often becoming wealthy without ever finding gold. Right? Now, what if selling shovel was being the house in crypto and digging for gold was trading crypto? Do you understand what I'm trying to say here? Right? So it might actually be better and more rewarding for you to sell shovels, so to be the house in crypto, than trading crypto, right? And you can see it here. So this is essentially everyone that made profit in crypto here, and that's the people that were being the house. So the exchange, the founders, the pump that fund, the devs, the people that rugged, the people that had honest projects, marketing team, people that are doing the sticker packs for telegrams, graphic designers, website builders, devs, you name it. Any people that is involved in crypto, but that is not trading coins. And this is the people that got rich trading coins, and it's a very small portion of the overall majority of people that were involved in crypto, right? So digging for gold is much harder. It's much harder to get rich while digging for gold than getting rich while selling shovels, right? So I want to talk about the invisible millionaires in crypto. So when you think about the rich people in crypto, you think about the people that you know or that you have seen on social media or on the news, or like big figures, like big iconic people such as CZ, Vitalik, big people in crypto. But you never hear about the marketing team of a project. Like, for example, let's go back to 2020. Let's take the case of Solana. Solana went from zero to past $200, all right, in less than a year. We don't hear about the people that got rich from Solana, the people that had token allocations in the project, the marketing team, the devs, the public relation, and more. And all the people that were involved in the project and that didn't buy the coin, but that maybe were getting paid with Solana. You understand? So being involved with a project, with a service, with a product in crypto will make you richer than being involved through being a trader, right? So understand this. Next, I want to show you a tweet from Base Boss. He said, most traders don't get rich, but many builders do. Traders look to take from others. Builders look to create for everyone. Scarcity versus abundance. Start building. I definitely agree with him because trading adds no value to the world. Whereas when you build something, you help people. You help people do something, right? But trading brings no value. It is a selfish practice, which is why it is very hard. It is very hard to be a good trader because it doesn't bring that much value to the world. Therefore, the universe has to punish you in some way. Now, it's often more advantageous to focus on providing tools and services like launching a coin, running an NFT project, building an exchange, or teaching investing rather than investing directly yourself. Right? So this kind of resumes everything that we said. Yeah. So if you really want to be a trader, you're going to have to put in the work, right? But if you want to be a part of the house, it is going to be much easier for you. What you could do is start creating content about crypto. You could start your marketing crypto project. You could start. There's a bunch of stuff that needs to be done in Web3 right now. So if you don't feel like you want to be a trader, there's definitely a lot of other opportunities which you can go into, right? Now let me ask you this: who is the richest person in crypto today in 2024? Who is it? So the richest person in crypto officially is CZ from Binance. And what does CZ do? He is the house. He created one of the biggest exchange of crypto in the history of crypto, right? He's probably never traded coins. He just brought value to the world, and now he is a multi-billionaire. I think he's worth like $60 billion, something like that, right? So you can see that the richest person literally is not a trader, but a builder, right? So this is just to show you an example. Trading adds zero value to the world. Building adds value and helps people. Remember this. Now, very interesting data here on Pump.Fun. So Pump.Fun is the fastest growing application by revenue in the history of the crypto economy. $100 million revenue in just 217 days. So how does that work? This is literally crazy. So basically, what Pump.Fun did is that they just brought what people wanted. People were already crazy degens in Solana, and then we needed something like this to come into the Solana blockchain, and all they did was providing the degen with what they wanted. So they started building a product, they launched it, and it worked really well for them. You see, this is how you make a lot of money, by providing value to the world. All right, so remember this, the house always wins, because the house is much more powerful than us traders. All right, so keep that in mind. I'll see you guys in the next class. Crypto is a giant Ponzi for the simple fact that early investors always make more money than late investors, right? So what is a Ponzi scheme? So a Ponzi scheme is a form of fraud that lures investors and pays profits to earlier investors with funds from more recent investors, right? So it was named after Charles Ponzi in the 1920s. Okay, so this guy right here. Now, what is the biggest Ponzi scheme that you can think of right now? Okay, so I want you to think about it, and let's see what the biggest Ponzi scheme in modern history is. So it is this guy right here, Bernie Madoff. So Bernie Madoff was the former chairman of NASDAQ, right? So NASDAQ, US stock index. And this guy was very big in finance in New York. And essentially, he started to create his own asset management business. And basically, he scammed everyone for $68 billion. So this is literally crazy. A lot of money here. And essentially, he was the mastermind of the largest known Ponzi scheme in history, worth an estimated $65 billion, right? So I said 68, but it's $65 billion that this guy has stolen from people. And this is crazy. So basically, he built his reputation, and everyone was trusting him, not only in the US, but all around the world. People were dealing with him, were sending him money so he could invest it and bring people some returns. But what happened is that in 2008, during the financial crisis, people wanted to take their bag, people wanted to take their profits, and they realized that little Bernie right here didn't invest the money, but Bernie scammed everyone, right? There's still some people that made money with this whole Ponzi scheme, and that's the people that were early, which is where I want to take you to in this course right here in this class. So let's go ahead and see a couple example of Ponzi scheme, and then we're going to take a look at the importance of being early into Ponzi's and how you can make money with Ponzi schemes, right? So number one, let's explain the crypto Ponzi steps, right? So let me go through the steps of how do crypto create Ponzi's, and how do people make money and other people lose money, and how the cycle repeats every time. So it always starts like that. So smart people create a new tech or financial experiment, right? These projects are getting a lot of hype. So people are hyping the new chain, the layer one, the new smart contract, whatever, right? All bullshit. People just want to make money, pump their project, and get out. And VCs do not care about the project. All they want to do is take their money and get out, right? They want to dump on you. And this is where the importance of being early is. All right. So basically the project go up in price. It creates a positive feedback loop, right? Because everyone is talking about it. Everyone that is invested in the coin is making money. But the price starts to go down. And this is when you have your exit liquidity that start to come slowly, right? So you have the first exit liquidity guys that are coming, and then the coin slowly dies down, coin slowly goes down, because you have the VCs and the early investors that are selling their bags and taking profit, right? And this now creates a negative feedback loop, and people start to see that the coin goes down and the exit liquidity is in a big loss. And then the cycle repeats itself every time with the new tech and something new that is coming every time, right? So this is how I want you to think about crypto, is that it is not, you are not investing in something that is changing the world. You are investing in massive Ponzi scheme. You ride the waves, you ride the hype, and you get out. That's how you should think about it, about most crypto, except probably Bitcoin and probably Ethereum as well. But we'll talk about this in another class. All right. Now, I want to give you an example here of Luna. So if you weren't here during the last cycle, we had this coin that went from zero all the way to $120. And essentially what happened is that this thing went to zero in like 3-4 weeks. It went to absolute zero. As you can see, the last 3 weekly candles are insane. And so basically everyone was talking about Luna. Everyone was hyped about that project, their whole blockchain. People were launching projects on Luna. And basically Luna had their own stable coin. But the only problem is that one day their stable coin started to depeg from the dollar, right? So it means that if you were holding, let's say, $10,000 in their stable coin, right? Well, one day you woke up and your $10,000 were worth like $5,000, right? So it went down like 50%, right? In one day. Absolutely crazy. And so it started creating a lot of FUD, and then the coin went to zero, right? So this is a great lesson that you don't want to be the guys that are coming last, right? Because a lot of people made money with Luna, but only the people that bought at the bottom and sold the top, right? So if you bought right here, you would have been dead. You would have been killed by the market and destroyed, right? So great example here of a classic Ponzi scheme. All right, number 2, let's take a look at Cardano. So Cardano ADA is a project that is still alive, I believe, but nobody is interested in it anymore. Nobody is using the chain. I don't know. I don't really know what's going on. There's way better stuff right now which you can invest in, way better layer ones than Cardano. But yeah, last cycle, this was very, very hyped. Everyone was talking about it, right? I personally got in Cardano at 12 cents. And then it went all the way up at $3, the $3 mark, and now it's back down to zero, right? So classic Ponzi here, classic crypto Ponzi. You can see here a lot of hype. No more hype, goes to zero, right? So you are not investing in the next incredible blockchain. Nobody cares about that, right? Let that for VCs, let that for people that have a lot of money to invest in utility projects. All you want to do is invest in hype, and which is why you can make so much money on meme coin, for example, because at least meme coins are not promising you the next blockchain. They're not promising you the next utility, the next technology. They are very honest with us because they are telling us we are a meme coin, we bring zero value, but we are gonna pump and you can make money riding the wave. So meme coins are basically a more honest altcoin if you want the truth, right? Now, let's go ahead and the last one here. So VeChain, right, was very popular last cycle, and same thing as well. Gained some hype right here in 2021. Went all the way up around 25 cents, 30 cents, and now is back at 2 cents, right? So crazy, 91% down, absolutely insane. Yeah, and this is supposed to be a utility project, right? So be careful. All right. Now, you can make money with Ponzi's, but you need to be early, right? And how to be early? Well, we're going to take a look at this. So number one, you want to have the right information at the right time, right? That's correct. You want to have the right information at the right time. And how do you do this? Well, you follow successful investors, right? You go on Twitter, you find 10 accounts that you like, that you think are successful, that are clearly showing proofs that they're making money. Then you follow them. And then after, what you do is that you join their private communities, you join their alpha groups, and you see if it works for you or if it doesn't, right? And it's probably going to take you a lot of trial and error before you find somebody that you like to follow. Maybe if you're an investor, you're not going to follow a scalper, obviously. If you are interested in like smaller risk project, you're not going to follow a meme coin trader on Pump.fun, right? So you need to find what you want to do and find the best people in that crypto niche, and then follow them, join their private communities, and see how it works for you, right? You want to follow people on X. X is very important. X is one of the smartest social media that we have out there. Number one, because everything is written, so you don't have the whole like TikTok mindset, crazy videos with high dopamine. Now, everything is written, right? So a lot of smart people on X. Everybody in finance is on X. Everybody in crypto is on X. So very important that you create an X account and you start following people. And you can follow me as well. All right. But the best thing that you can do first is do it yourself, right? So do it yourself, and you're going to become good at technical analysis. You are going to become good at fundamental analysis. And then after, you can find the people in which you trust, in which you want to follow. And yeah, just go from there. Find your influencers and stick with them. Very important that you stick with them. You don't want to jump from people to people, right? Stick with someone that is serious, buy their course, go in their paid community, and you are going to make money for sure. We are going to talk about the Dunning-Kruger effect and what it is, and especially what it does to your brain as a new crypto investor trader. So the Dunning-Kruger effect, it is essentially when you have a cognitive bias in which people with limited competence in a particular domain overestimate their abilities, right? So in other words, is when you think that you're the best and you know everything, even though you probably just got into crypto, this is your first cycle, you're still learning everything, but you are overconfident in the fact that you are going to make money, which you are probably not going to do. Very hard to be successful in crypto during your first cycle. You can ask any OGs, they all have experienced the same. Basically, people lose money during their first cycle. And the Dunning-Kruger effect is one of the reasons. Now, let's go ahead and see what this is all about. So, the way it presents itself is like this. So you come into a new competence, you're learning something new, because this applies to anything in life, any domain, right? Now, obviously, we are talking about crypto, right? So in the crypto case, so essentially, you know nothing about the subject, you know nothing about crypto, and you see that the coins are pumping, and you think you're going to take the next 50x, the next 100x, you think you're going to become a millionaire and retire your mom, right? This is all what we want to do, but it is very hard to achieve during the first cycle. So you know nothing, and your confidence goes up, right? So peak of Mount Stupid. So you're extremely stupid and ignorant over here. This is when you start buying stupid coins at stupid prices, and you are being exit liquidity, and essentially you get wrecked. Then you get humbled very fast, right? Very fast you get humbled. Then you are in the valley of despair, right? This is when you want to give up. This is when you think crypto is a scam, or trading is a scam in general. And yeah, this is when you're crying, you're in your bed, you lost all your money, and you don't know what to do. And then, if you're not a coward, then slowly you go up, you start learning again, even though this time you are learning and applying, right? You're not overconfident because the market has already humbled you in a very strong way. In other words, you can say that you are paying your tuition to the market, right? Because you are probably going to lose your money multiple times, right? It happened to me. I lost my money multiple times. I lost money in some of the worst times of my life. One time I had to pay my rent. I lost my rent money. Like, a lot of crazy thing happened to me in crypto. And yeah, so it's probably going to happen to you. Very dumb things, but crypto can destroy yourself, or it can make yourself better, right? So choice is yours, but you will have to be careful. We all learn throughout this journey. And so after the valley of despair, you have the slope of enlightenment. And this is when things start to click in your brain. This is when everything starts to make sense. You are being more responsible. You are practicing risk management. And now you can happily start making money, right? Because you are sustainable. You start being consistent with your strategy, with who you follow, with your risk management, and everything starts to be good. But we all experience this. Now, I'm going to show you multiple ways in which you can help yourself avoid the Dunning-Kruger effect, right? But first, I want to show you this graphic right here. So basically, in a crypto bull cycle, what happens is that we are at the bottom, and you're thinking that, oh, I'm going to buy lower. You're thinking you're going to have a retracement that you can buy lower. Then here you think it's a bull trap, right? So you think that you're not gonna you don't want to buy right now because you think it's still gonna go down, right? And here you think it's gonna be a double top, right? But it ends up not being a double top. Market goes up. I'm so stupid, I will buy on the next pullback. Well, guess what? There's no pullback. What the F? It's going higher. Panic buys here. So here you have the exit liquidity that comes in, and you have the even more dumber exit liquidity that buys right here at the all-time high. And then here you think it's just a small correction, but market continues dumping and dumping and dumping, and you lose all your money. And this is how you pay your tuition in crypto, right? Remember that when you trade, you bring zero value to the world, so the universe has to punish you in some ways, right? Now, I can tell you everything in this course. I can tell you anything. I can tell you not to do this, not to do that. But at the end of the day, it is you that has to be responsible for you, right? I'm not going to click the buttons for you. I'm not going to buy the coins for you. I'm not going to do risk management for you, right? So being in crypto is very much a personal experience for everyone, because nobody's holding your hand, right? And you are dealing with money, and money brings emotions, especially if you are still poor, which if you're watching this course, you probably still are. You're still poor, right? You're trying to make money, you're trying to get out the mud. But if you don't discipline yourself, it's going to be very hard for you to be successful in crypto, right? So I always have this analogy in my head where like when you tell a kid not to touch a candle or not to touch a fire or hot stove or whatever, he's gonna touch it. Why? Because a kid has to experience the pain to not do it again, right? Well, in crypto, it's pretty much the same thing. Even with grown adults, you can tell them multiple times, do not do this, do not do that, be careful with your risk management. No, no, no. They are still going to make mistakes and lose all their money, right? So you should be responsible and not burn yourself by touching the candle, right? Now, ways you can avoid the Dunning-Kruger effect, very simple. First, you want to follow a strategy and you want to follow it religiously. You want to be very strict with yourself and practice, being consistent and following the same strategy, right? Second, you want to have someone that you look up to, right? It could be a mentor, it could be a coach, it could be some influencer that you follow from Twitter or Telegram or whatever, and you want to stay consistent and follow the same person for a long time, as long as they're profitable and as long as they're doing well, right? Also, you want to invest early in the cycle. Now, let's say if you are watching this course in, I don't know, March 2025, well, it might maybe be too late to enter the crypto market because we are probably near the top. I am making this course on September 2024, and if you're watching this in 6 months, you can still apply the knowledge from this course, but it might not be good for this bull cycle, right? So you're gonna have to make your own decisions and evaluate if you are early, if you are late, or if you are in the middle of the cycle, right? Next, you want to exit when your mentor does. So if you're having someone that you can look up to, well, you want to exit when they exit. When they tell you to exit, just exit your position. Don't think about it. Don't think it's gonna 10x, it's gonna 50x. Nobody cares. Take your damn profits. How many times I've seen people doing a 10x or more and not taking profits, and then the trade reverse and they're actually losing. They actually end up losing in a position where they were doing a 10x. How is that possible? This is crazy, and this is what greediness brings and lack of knowledge, right? And last, you want to practice risk management, right? Extremely important. Risk management is the core of investing and trading. So only play with money which you can afford to lose, all right? Doing all of these, you're going to be successful and you're going to be able to avoid the Dunning-Kruger effect. We have to talk about FOMO. So, FOMO is fear of missing out, and it is essentially when you go crazy, when you are chasing the pump, you are chasing green candles, right? So, you obviously know what I'm talking about. This is when you are here and you're seeing a coin pumping, right? You want to jump in, then you end up jumping right here because you have no patience, you are greedy, you have zero strategy, you don't wait for a pullback, right? And essentially what happens is that once you got in, it goes down, and when it is down, you forgot how excited you were to get in, that you don't even let the trade play out. You don't even give the coin a chance. You don't even give the trade a chance. So what you end up doing is selling the bottom, and you do the opposite of what you should do, right? You are buying the top and selling the bottom, when in reality you should buy the bottom and sell the top, right? And then the coin goes back up and you end up buying here again, right? So the cycle repeats itself, and this is what FOMO does. Now, what causes FOMO? Well, number one is information overload, right? When you watch too many YouTubers at the same time, you are in too many alpha groups, you are in too many places, you follow too many Twitter accounts, your brain is everywhere. Crypto is so big, guys. You can be in AI coins, you can be in gaming coins, you can be trading futures, You can be in meme coins. Even in meme coins, you can be doing only Solana meme coins. You can be doing Solana meme coins only from Pump.fun. You can be doing only base meme coins. Like, there's so much choices. You cannot do everything. If you try to do everything, you are gonna get burnt and humbled by the market, right? Number two is poor risk management. So you have no risk management. You have like $500 or $1,000 and you just burn them because you are impatient, right? So very bad here, very bad habits that you are building and that are causing you to have FOMO in the market, right? Number three, you are impatient. So impatient, if you are not patient and you don't wait for your entries and you don't wait until you found a great meme coin or a great trade, a great coin to hop in, then you are going to get burnt as well. Same thing here, right? Now, FOMO is basically putting all of this together and creating the worst situation for your trading experience and for your wallet, because you are going to lose a lot of money. And usually when people start having FOMO, they build the habit and they are staying consistent in the bad habit, right? So you need now to unlearn to relearn the good stuff, right? And it takes time, but it works, okay? Number four is a lack of rules. So you have no rules, you have no trading strategy, you don't analyze charts the same way every time. You always like change indicators. One day you use Fibonacci, one day you use Bollinger Bands. You always change the way you analyze charts. So it is very, very bad. And number five, which is the worst of all, is boredom. You are sitting in front of your computer and betting your money in meme coins. Instead, what you should do is go outside, take some air, and come back when your brain is ready to invest and when your brain is ready to focus and have a clear strategy. Boredom will make you lose a lot of money in crypto, right? Do not be in front of your computer doing absolutely nothing. Have a plan, have maybe like 2 or 3 hours in front of a computer per day and get out. Do something else, right? You cannot be doing crypto all day. This is going to literally make you crazy, all right? So boredom is probably the worst of all, right? And it's probably what starts everything else. So yeah, so now you know what causes FOMO, right? Basically, you have the emotional roller coaster that is mainly caused by boredom and lack of discipline and lack of rules, right? You don't have any strategies. And then you get the lack of patience, you're getting impatient, then you end up over trading. Over trading kills every trader, right? So don't be that guy, be the opposite, be smart, and start making money. Now, how to avoid it? Well, you follow a strategy, you have a plan, and you stick to it. Very important. You practice good risk management, right? So you don't lose all your money. And you lower the information load. So stop listening to 10 YouTubers at the same time, right? Only pick a few good ones that you like and stick with them and keep following them. But don't be overloading your brain with so much information. There's way too many news. There's way too much information in the crypto market every day. Every day there's a news. Every day there's a new thing. There's a new chain, a new meme coin, new this, new that. You can't follow everything. So you need to stick with something, and that's the only way in which you're going to be successful, right? So lower the information load. Now, stick to one or two coins. This applies especially for future traders, right? People that are trading futures, because I see that so many times some future traders, they are changing coins all the time. So therefore, they don't understand the chart. They don't understand what's going on with that particular coin. So it's so much better to just pick one or two coins and trade them consistently, right? So you know how to get the fundamental news about them. You know like how to analyze the chart. You know what changed from yesterday, from last week, from last month. You understand the chart, right? So stick with one or two coins if you're trading futures. And now this is for the meme coin traders. If you are trading meme coins only, then stick to one chain at a time. Do not do chain hopping. Chain hopping is only for professionals, all right? Because the problem is that with chain hopping, you're going to have different wallets on different chains. Your risk management is going to be out of control. You're not going to understand what you do. So stick with one chain at a time, right? If you're on Base, stay on Base. Only look at memes on Base. If you're on Ton, stay on Ton. If you're on BSC, stay on BSC. Okay? Do not do chain hopping. Chain hopping will kill you. All right? All right, guys, so very important video here. So markets are zero sum. What does that mean? We are going to take a look at this in this video. So basically, when people say that market are zero sum, it just means that anytime you make money, somebody has to lose money on the other side. Or anytime you lose money, somebody is making money because you lost, right? So markets are zero sum, and they are actually three types of sum. You have zero sum, negative sum, and positive sum. And we are going to take a look at all those three. So zero sum game is basically a situation where one person gain or loss is exactly balanced by the opposite side loss or gain, resulting in a net change of zero, right? So this is just what I said. Basically, every dollar you make is a dollar someone lost. Value is not created in the markets. Value is distributed to the best players. So basically, the best traders, right? So anytime you've lost money on a meme coin or on trading futures or whatever, somebody on the other side was making money by selling on you or whatever, right? So basically, value is taken away from bad players and distributed to the best players, right? So basically, this explains zero sum very well. So you have this baby right here and this baby right here. This one had an ice cream, but this one stole the ice cream from him, right? So this is -1 for him and +1 for him. But for the market, it's zero, right? Nothing has changed for the market because basically there was one ice cream that was transferred to somebody else, right? So loser, winner. Okay, so this is zero sum. Now, we also have PvP, which is player versus player. If this summer you were in the Solana trenches with the whole Palm.fun and all these meme coins, this was a very PvP market driven, right? So basically it was player versus player. So these are the hardest market environment to make money, right? So basically PvP is a market environment where investors engage in competitive trading against experienced crypto traders, right? So yeah. So basically a PvP market is pretty much like a fight, like a boxing fight. So if we take a look here, basically you have the loser, which was Connor, and then you have the winner, Khabib, but you have Dana White. So who is Dana White? He's the house, right? CEO of the UFC. So the outcome of this fight doesn't matter for Dana White because he will always make money. If he wins, he makes money. If this guy wins, he makes money, right? So he's making money either way. So basically, the house in crypto is the hedge funds, the exchanges, the devs, also the venture capitals, the VCs, right? So basically, that's what it is, right? Player versus player, and you have the house that always makes money. Now, the house makes money because you have fees, you pay cost transactions, you pay a bunch of stuff anytime you do a transactions, right? Now, we also have PvE. So PvE is the other side, is the positive sum, and basically it's player versus enemy. So every 4 years in crypto, we get what we call a bull market. Obviously, you've heard of that. So the bull market is basically when it becomes extremely easy to make money, right? Even a donkey could make money in a bull market, right? You give anybody a little bit of cash, they come into crypto in the bull market, they are going to make money, right? This is when it is extremely easy to make money, and that is a positive sum. Now, basically what happens is that the newcomers who doesn't know anything about crypto is very excited, he's very hyped, he's going to buy the new meme coin, the new ship, the new Pepe, whatever. But essentially what he does is losing his money by giving it to the experienced trader, the people that have been here for a while, right? So this guy is in his first cycle and he thinks he's going to make a bunch of money, but he's really not. he's going to lose it all, right? And he's giving money to this guy, the experienced guy that has been here for a while. It's probably his second, third, or fourth cycle. He's been here for a while, right? So the first cycle, you are exit liquidity. And in the second cycle or plus, you are making money. You're taking money from the newcomers. And this is only happening during the bull market, which is an extremely easy way to make money in crypto. Now, basically, in your first cycle, you lose money, right? Now you could argue that some people make money during their first cycle, but it is very rare. And even if they manage to make a bit of money during their first cycle, they're probably going to lose it all. They're not going to take profit on time. They are maybe going to get hacked. Their wallet's going to get hacked. They just don't know. They just don't know. They're newbies, right? And we all been there. And then second cyclers are making money. And then third cyclers are making more money. And fourth cyclers are probably multi nine figures or billionaires, right? Now, this is basically what happens every time. This is the 2020 chart of Bitcoin on the daily. So basically the second cyclers plus, so all your OGs in crypto, they bought Bitcoin around 10K or even lower, or this whole area right here. And then crypto pump, because a lot of people were buying. And then here you have all the newbies that are coming into the market, right? But they are coming near the top. And some people are going to buy right here on top, but some first cyclers are going to buy like right here, right? And so here they make a bit of money, and all this money, they are not going to take profit on it because they have all the emotions, greediness, they don't understand the market psychology, they don't understand trading, they don't understand technical analysis, they probably don't even know what the Fed is doing with the rate cuts and all that stuff, right? So this is very hard for first cyclers, but this is a break it or make it situation because your first cycle is going to teach you a lot about yourself and about the crypto market. And then choice is yours if you want to stay and become second cyclers, which you're most likely to make money if it's your second cycle and you know what you're doing. You have networking now. You are in Telegram groups. You are on X every day. You know technical analysis. You know how crypto works. And that way you're going to be able to make money. Now, on the loser side, you're going to lose money on your first cycle and you're going to give up. You're going to be like, yeah, crypto is a scam. I lost all my money during this bull market. I don't want to come back, right? So this is the loser mindset. All right. So basically, your first cycle, you pay what we call your tuition fee, right? Because you will most likely lose it all on your first cycle. And basically, you have to learn the hard way. It's just how it works. You have to learn the hard way. We all been there. We all have lost money in crypto. And the best thing to do after you lost money in your first cycle is just to stick around and keep learning to prepare for the next bull run, right? So you want to be able to prepare. Now, also, even those who manage to be profitable on their first cycle will most likely not take profit and end up in a loss, right? So this is what I said earlier. People that have made money in Shiba Inu or Dogecoin last cycle or Cardano or whatever, the first cycle guys, maybe they made like 10K, 20K, but then greediness came and they became so greedy, so hungry, they thought like it was never going to end, right? And experienced people sold on them, right? So yeah, very hard to live, but we all been there, and you have to go through that if you want to become an experienced crypto investor or crypto trader. Greed will be very hard to control for newcomers, right? Now, basically, the mindset that you want to have when this happens is you have two types of mindset, right? You have the guy that lost all his money and he's going to be like, crypto is a scam, I'm leaving, right? He's all sad. That's basically the loser, right? That's the loser. He's not going to come back into crypto. And that's good because we don't want losers in this market. We don't want that mindset. We want people that want to build, that want to grind, and that want to change their life, right? So the second mindset, which is the winner mindset, is I will continue to learn and get rich next cycle, right? He's sad. He lost all his money, but he knows that there is an opportunity every 4 years and that if he works hard and he invests his money right, he extend his networking, he joins Telegram groups, he's buying a course on crypto, whatever, he keeps educating himself, then he's going to make it, right? That's the winner mindset that you want to have.